I may say things aren't quite as strong as they appear, and we may look ahead and say they're going to get worse. But the plain fact is, if you look at the macroeconomic environment right now, it is a negative environment for gold. And so the ordinary investor perhaps sees that. And what's been driving gold in particular, of course, are things, central bank buying because of dollar weaponization, Chinese investors buying because they're worried about the banking system. Well, these people are not worried about the macroeconomic environment. That's not why they're buying gold in the first place. So it's not illogical that gold is moving up to new highs and we're still not seeing a flood of people pouring into gold stocks.
The macroeconomic landscape is crucial in shaping how investors view gold. Low interest rates, negative real interest rates, high inflation, a weakening dollar, and a slowing economy typically drive prices upward. However, Adrian Day highlights that these conditions aren't currently present. Instead, the increase in gold prices is fueled by a surge in purchases by central banks and Chinese investors. These actions are driven by fears over the weaponization of the dollar and concerns about the stability of China's banking system. Interestingly, gold prices are hitting record highs across developing and developed nations. One of the driving forces behind this is China's strategy to hedge its currency against gold, leading to significant gold purchases globally. The People's Bank of China, PBOC, exercises strict control over gold imports through quotas for commercial banks. In 2023, the PBOC emerged as the largest official sector buyer of gold, purchasing a net total of 7.23 million ounces, 224.9 metric tons, marking the highest annual acquisition since at least 1977, according to the World Gold Council. On another front, many expect the Federal Reserve to cut interest rates in September. However, some experts argue that the Fed may choose to hold steady, or should at least consider doing so. Interestingly, despite these anticipated rate cuts, gold prices remain largely unaffected. This is because the primary buyers of gold, central banks and Chinese investors, are not particularly influenced by shifts in U.S. monetary policy. Instead, a significant but less visible factor in the gold market is the activity of wealthy individuals from the Middle East, Asia, and North America who are making discrete over-the-counter gold purchases. These transactions, which don't show up in public reports like central bank activities, suggest that concerns about systemic stability and financial fragility drive underlying market movements. We will present clips from Adrian Day's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think the plain fact is that, if you look at the macroeconomic environment and look at the things that drives gold, lower interest rates or negative real interest rates and higher inflation and weaker dollar and softer economy, meaning the Fed's going to start cutting rates. I don't think the gold prices, I may be wrong, but I don't think the gold price is pricing in rate cuts at the moment. Again, because look who's buying. It's central banks who are buying. They don't care what the Fed does about rate cuts. It's Chinese buyers. They don't even know what the Fed does about rate cuts. There's also clearly some additional buying when you add up the numbers. You look at the central bank buying, which is reported, the Chinese buying, where you have very good numbers from the Shanghai Exchange and from Hong Kong imports into China. And you have Chinese gold production, of course, which all goes to the central bank. But in terms of a consumer in China, it's the Shanghai Exchange and it's Hong Kong imports. You look at those numbers and then you look at the ETFs and you look at the outflows from the ETFs. There's a missing component, right? There's a missing component, and a missing component, discerning, intelligent, but wealthy. A few wealthy individuals and families in the Middle East, in Asia, and also in North America, but a few wealthy individuals who are buying gold over the counter. So the individual trades are not getting reported, right, in a way that individual central bank purchases and sales are being reported. They're not being reported, but this is OTC, over-the-counter buying of gold, and that's what's driving gold. And I don't think those people are buying because of Federal Reserve interest rate cuts. I think they're buying because they're worried about the fragility of the system, frankly. The macroeconomic environment, all of the factors that normally drive gold are actually negative right now. That's a positive if you're a contrarian, because it only means, the Fed has to cut rates, or inflation has to go back up, or the dollar has to fall, or the economy has to slow, or the stock market doesn't have to collapse, but it has to roll over. Are any of those things possible in the next 6 months? I would say absolutely overwhelmingly, yes. So when the macroeconomic environment starts to shift, ordinary investors and small institutions will turn towards gold.
The U.S. inflation rate has come down significantly from its peak of over 9% 2 years ago to around 3% today. This drop suggests that inflation might stabilize within the 2.5 to 3% range, which most economists consider a sign of financial stability. Despite this positive trend, the Federal Reserve will likely approach any interest rate adjustments cautiously. When the Fed's Federal Open Market Committee, FOMC, meets on September 17th to 18, we might see a signal indicating a possible future rate cut rather than an immediate change. If the Fed fails to act on its policy adjustments in July or September, it could be seen as another blunder, compounding the criticism it faced for its initial slow response to inflation in 2021. This hesitation could further undermine the Fed's credibility. Adding to the complexity, Adrian highlights a looming concern about the potential for interest payments on government debt to surpass a staggering $1 trillion. This significant fiscal burden might spark heated political discussions, adding another layer of pressure on the Fed as it navigates its decision-making process.
I think it's important, sometimes if you put it into a human story term, it's easy to understand. The individual the family that bought a used car, 5 or 6 years ago, and they probably paid, I don't know what used car loan rates are, to be honest with you, but let's say LIBOR plus 5. Would that be reasonable?
Probably sounds about right. Yeah.
So 7 years ago, they would have paid 6%. Now that clunker is dead, and the family has to go out and buy a new car. Well, now LIBOR plus 5 is 10%.
Yeah.
So the rate that they are paying has just gone up. The monthly payment has just gone up dramatically, and this is a family that might be living, paycheck to paycheck. So they could just about make the paycheck, the payment on the last car. Now it's suddenly gone up by 60, 70%. The company that borrowed money 5 years ago at LIBOR plus 2, 2.5 plus 2, they were borrowing a good quality, a good credit 4 years ago, 5 years ago, could borrow 4.5, 5%. Now they're borrowing at 8, 9%. I mean, and that money is going to roll over. So the higher for longer mantra, the longer we go on with interest rates where they are, then the more households, the more corporations who may be good credits or they may be poor credits, but the more households and corporations suddenly come into the new higher interest rate environment. I mean, if a company, let's say a company termed out all their debt 5 years ago, the higher interest rates haven't affected them.
No.
Until their debt matures, and they have to roll it over. Then it suddenly affects them all at once. So, the Fed is in a very difficult position. Jerome Powell, clearly, we know this anecdotally from people who know him, Jerome Powell is concerned about his legacy. He does not want to go down as, everybody says, the other Arthur Burns, which is a little unfair on Arthur Burns, but he doesn't want to go down as the person who, cut interest rates too soon and allowed inflation to blossom. And I suspect that if Jerome Powell keeps interest rates higher a little longer than he should, but manages to bring inflation down, he can retire when it's time for him to step down. Even if the economy is in a little worse shape and unemployment is a little bit higher, he can say, I killed inflation. The truth is he cannot kill inflation in the way that Volcker did. We forget when Volcker came in, the Fed funds rate was already double digits. So Arthur Burns wasn't quite so bad. It was there was Miller between the two, but So we already had the Fed funds rate, I think, at 12%, but it was certainly double digits when Volcker came in. And Volcker doubled them, more or less doubled. Powell simply cannot double rates from now. I mean, he got way ahead of inflation, Volcker. We simply can't do that right now because of the debt in the economy.
As central banks ramp up their gold purchases, we can anticipate significant effects on the gold market. With 2023 seeing 1,037 tons of gold bought and 29% of central banks planning to add more reserves in the coming year, this robust demand will likely drive gold prices higher. The trend of central banks, including major players like India, actively increasing their holdings will likely support gold's value, even in volatile economic conditions. This sustained buying pressure underscores gold's role as a safe haven amid ongoing geopolitical and economic uncertainties. Share your thoughts on Adrian's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.